Goal here today with both of these strategies is going to be to benefit from neutral behavior in the underlying stock with limited risk and at a very cheap cost. So again, you'll know right from the start what's the most you can lose with these strategies. And so the ideal situation here with both of these strategies is you believe a stock will trade sideways, in other words, not move much up or down, basically trade within a pretty defined range, and you'd like to take advantage of this by entering some pretty cheap option plays. So before I get into these two strategies, guys, I'd like to introduce today's sponsor, Webull. So right now you can get 5 free stocks valued up to $9,600 when you open and fund a new account by using my link in the description below, and also get $5 of crypto by completing a minimum $1 crypto trade. So again, I'll put a link to Webull in the description below. Go ahead and check them out, guys. So with that being said, let's get into the first strategy here. So I'm going to be using ticker symbol NKLA for today's video. This is Nikola. Keep in mind, these are just examples, so don't copy these exact same trades. But let's say that we think Nikola's not going to move much for the next couple of weeks. It's going to basically trade sideways. So we could potentially use this stock for these strategies. And so remember, before you actually go into the options, 2 things you should always check. First thing is commission fees. We are going to be opening and closing multiple contracts here today. If you're on a broker with high commissions, that might eat away at a lot of your profit. Now, Robinhood doesn't have any commissions, so we don't have to worry about it on here. The other thing is we're also going to be selling options. So anytime you sell an option, there is risk of assignment. You want to avoid being early assigned due to the ex-dividend of a stock. So always check if the stock has a dividend. If it does, check when the ex-dividend date is. You want to avoid selling options on the week of the ex-dividend. If you do, you want to close out 2 days before. Now, Nikola doesn't have a dividend, so I wouldn't have to worry about that. So let's actually go into the options here now. And so right away, guys, first thing I'm going to mention here is you do not need 100 shares of Nikola to use either of these strategies. And so let's say that we believe Nikola isn't going to move much for the next couple of weeks. So what I'm going to do is I'm going to start by using calls here for this first strategy. We're only going to be using calls. And the way you set up this first strategy is you first pick a proper expiration date. So again, if we think it's not going to move much for the next couple of weeks, maybe I'll go out a couple of weeks to like May 6th. Maybe let's say we think from now till May 6th, it's not going to move a whole lot. So I'm going to choose May 6th for today's example. So the first thing you would do here is you would try and determine what price you believe Nikola will be on the expiration of May 6th. And so since we think it's not going to move a whole lot, let's just say we believe it'll be at around the same price that it's at right now, so at $8.50. And so the way you would start this is you'd start by selling 2 call options at that strike. So $8.50, I'd sell 2 call options here, and I'll show you guys how to change the quantity for each contract here. So we'd start by selling 2 calls. Now we want to switch over to buy, because now we want to buy some calls. And so what you'd want to do is you'd want to buy a call with a higher strike than the strike of the call you're selling, and buy a call with a lower strike than the strike of the call you're selling. And what's very important is that these 2 calls you're buying are the same distance away from the call that you're selling. So in other words, if I buy my first call at the $9 strike here, this is going to be 0.5 away from the call that I'm selling, meaning the call I buy down here should also be 0.5 away from the call that I'm selling. So in other words, I'd have to buy the call at the $8 strike, so right here. And then remember, we actually want to sell 2 calls, not just one. So we can go up here, click on this drop down, go to custom. And then for the call that we're selling, we want to switch this to 2. So I'm going to click in here and we want 2. And so here's the strategy, right? It's going to tell you that you're entering for a debit here, total cost, and it's going to be $3. So you're going to pay $3 to enter this strategy. And basically, you're going to be risking $3 to potentially make around $47 here. Very high reward to risk. And if you take a look here, right, you'll see that the stock can still go down and it can still go up and you'll still be able to make money. But for the most part, you're going to want this stock to trade sideways. Now, again, I would go ahead and use option strat to visually take a look at what this trade will look like depending on the price of the stock, depending on the date, depending on implied volatility. So let's do that here very quickly. Let's go to option strat. Let's go to build. And again, we'll just go to long call. We'll start with a call here. And so we chose ticker symbol NKLA for today's video. So Nikola, we went to May 6th here because we think that it's not going to move much from now until then. So we started by determining what price we believe this stock will be on the expiration. We said, well, we don't think it's going to move a whole lot from now until then. So let's just say we think it's going to be at close to the same price it's at right now. So 850. So we started by selling 2 calls at that strike. And then we went ahead and we bought a call with a higher strike. I went to the one right above it, and we only want to do 1 here. So let me go 1 here. And then we also bought a call with a lower strike than the calls that were selling. So I went to the $8 strike right here. So this is what it looks like here, right? You're entering for a debit, meaning you're paying to enter. And that's also the most you can lose here. As you can see, max loss is 3, net debit is 3, max profit is $47. And so what you'd want to happen, ideally on the expiration, is for the price of the stock to be at the strike of the calls that you're selling. So in other words, you'd want it to be at exactly $8.50 on the expiration. That's where you'd make your max profit of $47, which would be a huge return, right? We're talking 1,500% return. All these returns here are pretty huge, 300, 400, 200% returns. Now, what I wanted to talk about here specifically in today's video is what if we set this up using puts instead? Because we can do that, right? Here we used calls, but what if we had set this up using puts instead, right? When would we want to use puts? When would we want to use calls? So let's first go back here to Robinhood, to a new tab, and let's take a look at what this looks like using puts instead. So let's go into the options here, and we're going to choose the exact same expiration, which was May 6th. So let's go to May 6th. But now we want to use puts instead. And let's take a look here. So it's going to be the same process, right? You want to start by determining what price you believe this stock will be at on the expiration. So again, let's say we think it's not going to move much from now until then. It'll be at around the same price, $8.50. So you start by selling 2 puts at that strike. Then again, we want to also buy a put with a higher strike and buy a put with a lower strike than the strike of the puts that we're selling. So again, I'm going to go to the exact same strikes I chose for calls. So I'm going to go to the strike right above it, 9. And then again, same thing here. The distance between the call you're selling and the call you're buying up here needs to be the same as the distance between the call the put you're selling and the put you're buying down here. So I'm going to have to buy this put here. And then finally, I want to come back here, go to custom, because I want to sell 2 puts, not just 1. And so this is what this one is going to look like here. Now notice this tells me it's going to be around $1 total cost, right? So here it's telling me that I'm going to risk $1 to potentially make $49. Okay, now will you be able to get in for $1? Probably not, but you could probably get in, for a very cheap price, maybe $3, $4. Same thing with the other one. Will you be able to get in for $3? Probably not, but maybe $4, $5, $6, right? But ultimately, right, this is showing me a better cost here. So again, let's take a look here at what this looks like. So let's go over to option strat here. Let's go to build. And again, we'll start with put here. So again, we are choosing ticker symbol NKLA here. So NKLA. We chose the expiration of May 6th. We started by determining what price we think the stock will be at on that expiration. So again, let's say we think it's not going to move much. We think it's going to be at around the same price it's at right now, so $8.50. Then we bought a put with a higher strike. And then we only want 1 here, so we chose the $9 strike. And then we bought a put with a lower strike, and that has to have the same distance from the puts that we're selling as this put with the higher strike. Okay, so they're both 50 cents away here. So this is what this one looks like here. So again, this one's telling me my net debit is $1. That's also going to be your max loss, right? The most you can lose here is $1 if you get in for $1. Max profit is 49. So very similar, right, to the last one here. What we want to ideally happen is for on the expiration date, the price of the stock to be at the strike of the put that we're selling. So in other words, at 850, because that's where we're going to make our max profit. Again, huge returns here. So for this one's even bigger, right? Almost 5,000% return here, because this is only giving us that, it is only telling us that, you know, we're only risking $1 here. But anyways, pretty big returns here, right? So what's the difference here? Well, first of all, they're very, very similar, right? Synthetically, they're the same. Like I mentioned, your max profit will be at the same, you know, for both, right? At the strike of the puts or the strike of the calls that you're selling. They're both neutral strategies. They both have very similar reward to risk, right? But the difference here, and what you want to look out for, right, when you're trying to pick one over the other, is firstly, you want to go for the one with better liquidity. Because if liquidity is better for one than the other, you're going to be able to get in, you know, easier, and then close out of it easier as well. And kind of related to that is you want to check and see if one has better pricing, right? For example, like here, right, this is telling me this is going to cost $3. But with using puts, it's telling me it's only going to cost me $1. So sometimes you can find these where one has better pricing. One might cost, you know, $1 less. And with even it costing $1 less, you know, that's a lot better. Your reward to risk will look a lot better. So you want to go for the one with better liquidity because it'll be easier to enter and close out of. You also want to check for better pricing, right? Sometimes, like I said, one might be a little bit cheaper. Now, the other thing you need to think about here when trying to figure out which one you should choose, right? This one or this one, is think of assignment, okay? Because if, let's say, you enter this this strategy, right? But let's say you believe that there's a possibility of the stock going higher if it doesn't trade sideways. Well, in that situation, if you think there's a possibility of it going higher, you might want to go for using puts here. And the reason why is, let's say Nikola does go higher and it goes to 950 by May 6th. What's going to happen to these puts that are in the money right now? They're going to be out of the money by then. That means you don't have to worry about being assigned because they're not going to be in the money anymore. Now, if you were to use puts and the stock drops, right, by May 6th, these will all be in the money. And so now you're at risk of assignment. So if you believe that Nikola has a chance of going higher if it doesn't move sideways, you might want to use puts because if it does go higher, then all of these puts will be out of the money. You don't have to worry about assignment. Now, if you believe the stock might go lower instead, and instead of trading sideways, then you probably want to go for calls because what's going to happen if Nikola goes to like 750? Well, now these calls will all be out of the money, right? Right now we have this one that's in the money, but if Nikola goes under 8, this will be out of the money. And so now you don't have to worry about assignment because they're all out of the money. So that's another thing that might not be obvious here, but something you should watch out for, right? So when it comes to assignment, if you think the stock's going to go higher here, you might want to use puts. That way they're all going to be out of the money and you won't have to worry about assignment. If you think the stock might drop lower, you might want to use calls here because that way if it does drop lower, all your calls will be out of the money. You don't have to worry about assignment. But beyond that, these two are basically the same thing, okay? But again, sometimes you may find one that has a little bit better pricing than the other one. So always check both here. And again, always keep assignment in mind as well. So anyways, if you guys have any questions about anything I just talked about, feel free to leave them in the comments section below. Check out the Discord, a link to it in the description below. Hope you enjoyed the video. Let me know what you guys think. And I will see you guys next time.